Today's video is all about risk. Let me tell you something uncomfortable. Most people don't lose money in the market because they pick the wrong stocks. They lose money because they panic at the wrong time. It's not about strategy, it's about emotion. When your portfolio is down 20, 30, or even 40%, it's not a math problem anymore, it's a psychological battle. And that's exactly why today's video matters, because we're not just talking about returns, we're talking about how to build a portfolio that you can actually hold on to when things get tough. A portfolio that keeps you invested, keeps you calm, and helps you avoid the most expensive mistake in investing, selling low. This couldn't be a more relevant topic given the past 6 weeks in the markets. In this video, we'll explore why volatility hurts more than most investors realize, how emotion, not just numbers, shape outcomes, the structure of a balanced portfolio designed to reduce drawdowns while keeping you exposed to growth, and why, in the real world, a slightly lower return with much lower volatility might actually get you further in the long run. We'll also show you a performance chart comparing a balanced portfolio to the Nasdaq over the past 5 years, including total returns, max drawdowns, and how each portfolio feels during a crisis. Let's start with the things that matter most, your behavior. Now let's be honest, most people don't stick to their plan when things get uncomfortable. They say they're long-term investors until their account is down 25%. They say they'll buy the dip until the dip turns into a free fall. They say they're diversified, but they hold 5 different tech stocks. It's easy to have conviction when markets go up. The real test is how you behave when everything turns red. And for many investors, that test comes sooner than they think. Now let's look at the last 5 years. The Nasdaq delivered a 148% return. We're talking to the end of March 31st. Sounds amazing, right? But that came with a 32% drawdown in 2022 and a 13% drop more recently. There were multiple other corrections of 10 to 15% along the way. And here's the question. How many investors actually held on? How many sold partway through the fall? How many never got back in? Now look at a balanced portfolio over the same period. Same starting point, same market, but instead of 148%, it returned 83%. Still strong, but not as flashy. The difference, a maximum drawdown of just 14%. And the recent volatility, it's down just 4.5%. Let that sink in. Same environment, half the pain, most of the gain. That's the value of balance. The best portfolio in the world is useless if you bail out during a panic. That's why returns on paper aren't the whole story. You need a portfolio that fits your mindset, not just your risk profile on a form. Because if you can't stay invested, you won't get the returns anyway. And that's where the balanced portfolio comes in. Let's break it down. A balanced portfolio is designed to give you exposure to equities for growth, bonds and short-term instruments for stability, diversification across sectors, styles and geographies, and a smoother ride through both bull and bear markets. For the demonstration of this video, we're using 10 US listed ETFs that can easily be replicated by everyday investors looking for more stability, all chosen for their liquidity, cost efficiency, and historical performance. Let's look at the structure. Here's how it's allocated. US large cap, think the S&P 500, 20%. Nasdaq 100, 15%. The Dow Jones Index, 15%. Global Infrastructure, 10%. Small cap value, 5%. Developed international markets, 5%. US bonds, 10%. Global bonds, another 10%, but they're hedged. Short-term treasuries, 5%, and ultra-short-term, another 5%. Now let's look more closely at the ETFs used to create this portfolio. Firstly, VOO, Vanguard S&P 500. This is your broad market anchor. 500 of the biggest companies in the US/world, lower fees, high liquidity, proven over time. Next, we have QQQM, Invesco Nasdaq 100 ETF. This is your high growth allocation, heavy in tech, innovation, and disruption. Lower fees than QQQ, better for long-term holders. Next, we have DIA, the ballast, high quality, dividend paying stocks. Think Johnson & Johnson, Coca-Cola, McDonald's, less volatility, especially during sell-offs. Together, these three form the heart of your equity exposure. Next, we add IGF, iShares Global Infrastructure ETF. Why? Because infrastructure behaves differently from tech. It holds utilities, toll roads, pipelines, and airports. It pays dividends and gives you real-world exposure that often moves independently from the stock market. 10% goes to this. Then we add VBR, Vanguard Small Cap Value ETF. Why value? Because these companies are often more resilient during changing rate environments. Why small caps? Because they tend to outperform large caps over long periods. It's a 5% allocation, small but strategic. Next, we allocate 5% to VEA, or Vanguard Developed Markets ETF. This gives you exposure to Europe, Japan, Australia, and more. It reduces home bias, but remember, nearly all of the companies in the US indices have global exposure already, hence the small allocation here. It also adds diversification that can shine when US markets stumble. Let's now talk about the part of the portfolio that gives you resilience: bonds. In this balanced portfolio, we allocate 20% to fixed income, half in US bonds, half in international bonds, hedged to the US dollar. First up, we have BND, Vanguard Total Bond Market ETF. This makes up 10%. It gives you access to full spectrum of the US bond market, treasuries, mortgage-backed securities, investment-grade corporates. It's broadly diversified and built to generate income, while also acting as a cushion when equity markets fall. And secondly, BNDX, Vanguard Total International Bond ETF. This holds high-quality government and corporate bonds from outside the US. But, and this is important, it's currency hedged, so you're not taking on FX risk. You're simply diversifying across economies and interest rate cycles. BND and BNDX combined give you reliable, diversified global fixed income. Now let's talk about the cash-like part of the portfolio. 10% is allocated to short-duration treasuries and bills. Why? Because they add stability, liquidity, and in today's rate environment, actual yield. Firstly, VGSH, Vanguard Short-Term Treasury ETF. This makes up 5%. It holds treasuries maturing in 1 to 3 years, very low volatility, modest yield, and it holds up extremely well when markets sell off. And next, SGov, iShares 0 to 3 month Treasury ETF. This makes up 5%. SGov is practically cash, but with yield. It holds treasury bills maturing in under 90 days. No risk of big price swings, daily liquidity, and right now, one of the highest yields in the entire portfolio. Together, VGSH and SGov form a rock-solid 10% buffer, giving you room to breathe during uncertainty. Now, putting it all together, let's zoom out. Here's the full balanced portfolio. 50% equities, 20% bonds, 10% infrastructure, 10% short-term and cash, 5% small cap value, and 5% international equity. It's globally diversified, it's sector diversified, it's built to grow, but also built to survive. That's the edge. So what does it actually look like in practice? Let's start with the headline. Over the past 5 years, the Nasdaq returned 148%, but with a 32% drawdown and a 13% drop just recently. The balanced portfolio returned 83%, with a 14% drawdown at its worst and just 4.5% down during the latest dip. Let's take a look at the chart. It's not just about how high you climb, it's how often you crash on the way up. Now let's put that into dollars. If you invested $100,000 5 years ago, the Nasdaq would now be worth $248,000. The balanced portfolio would be worth about $183,000. But ask yourself, which one would you have actually stayed invested in? Which one would you have been able to hold through the worst days? Because if you sold the Nasdaq during the crash and missed the rebound, you didn't get that 148% return. You might have gotten half or worse. This portfolio isn't for everyone, but for many investors, it's exactly what they need. It's for people who don't want to check their portfolio every day, value consistency over excitement, want to grow wealth without being on a roller coaster. It's for professionals, for families, for pre-retirees, and for anyone who's ever sold low and regretted it. Because here's the thing. This portfolio won't be the top performer every year, but it's designed to keep you invested every year. And that's what wins over time. It works with your behavior, not against it. It doesn't try to predict the future. It prepares you to survive it. Oh, and one more thing, yield. This portfolio currently yields about 2%. That means $100,000 investment generates about $2,000 per year in income. That's not just a bonus, it's a cushion. It can be reinvested or used as cash flow during retirement. And in an era of high rates, it's more valuable than ever. Here's a quick look at how this portfolio performed over the years. Even in the worst year, 2022, the drawdown was less than half the Nasdaq. and it bounced back fast, and that's the point. So here's the takeaway. If you've ever panicked during a crash, if you've ever sold low or hesitated to get back in, if you want to grow your wealth, but you want to do it in a way that's more smooth, consistent, and manageable, this kind of portfolio could be exactly what you're looking for. Now, all the ETF tickers and allocations are in the description below. Use this as a framework, customize it if you need to, but above all, stay invested. If this helped you think differently about your strategy, give the video a like, subscribe for more videos on long-term investing built for real people with real goals. Thanks for watching, and remember, the best portfolio isn't the one with the highest return, it's the one you can actually hold on to. We'll see you in the next video.